Hello everyone, and welcome to another edition of Over the Horizon, ACY Securities Economics. I'm Clifford Bennett, Chief Economist, and a lot of people in this crisis, in this lockdown period, have nothing else to do but sit down and take in the scenery, experience a little bit of peace and quiet relatively. I mean, if there is an upside, it is that the city is a little bit more quiet and you can hear the birds chirping away a little bit more clearly. Obviously, overall, that's not a positive. Other people are coming out now and joining us in the chorus of this is going to have a major economic impact. It's not going to be a temporary blip. And I'm thinking that we could see 3.5% taken off the GDP rate for the current quarter. That's a lot. So watch out for a negative quarter, certainly, and it may not be an escape routine that we do get out of actually having a recession here of 2 negative quarters. So that's a worst case scenario, but it is a possible worst case scenario to be considering for the Australian market. That's what makes the rally in Australian stocks on Friday all the more interesting. There's really no good news on the horizon at all for Australia in the current situation. It might be nice that Victoria and South Australia are going to come out of lockdown on time as planned. But it doesn't mean all of Australia is free and out of the woods as yet. And we know that Queensland's having these sort of 1 or 2 cases pop up here and there. So we're not sure what the real situation is in Queensland at the moment. But certainly New South Wales is the one feeling the pain and the lockdown looks set to continue. In terms of overseas markets, we've seen what I call a world awash with too much money, but we've seen that scenario combine with, because I've noticed the tide coming in here as well actually, but I think combine the idea that the world is awash with money from stimulus measures with that the rise of the Delta variant is actually causing fear in large parts of the world and inspiring, if you like, pushing more fresh capital, investment capital into the United States, which is seen to now be at least vaccinating and on the way to having a better vaccination level than a lot of other countries around the world, but not as good as the UK or Israel, but certainly doing reasonably well. So it's something to watch out for there, that there's some people are wanting to invest in the US as a relative safe haven to some other parts of the world that aren't embracing vaccination quite as highly. The other aspect, of course, I've talked about before is that inflation is a product at the moment of people having pricing freedom, so they're putting their prices up, not losing market share for doing so, maintaining profit margins. That's leading through to higher earnings. So both those negatives of inflation and Delta that I was warning of, the twin tsunami, have kind of come across the horizon, but they haven't done quite as much damage as I thought they would initially, not at this point. But their long-term impact is going to be severe and to the downside. And at the moment, we're going to see short-term impact from, obviously, the COVID crisis in New South Wales. In terms of the whole world, though, that push of capital into the United States is driving US stock markets higher and making people feel comfortable and okay that markets are in a good state. But a lot of fund managers in New York are actually very concerned about valuation levels, about the Delta surge within the USA, and about the ongoing threat of inflation and how difficult it will be for central banks to cope with that inflation threat while there's a Delta surge and a slowing economy, because a whole lot of stimulus-driven economic activity from the future was brought forward into the past year. So all of these forces combined make people wonder why US stocks are going so high, why the Australian market broke to the upside out of that range of the last month or so. And all that sort of head scratching is leading to a little bit of faltering in those markets. If you look at the the S&P daily, 500 daily, it has had a clearly strong run. I certainly didn't expect it to make these new highs. You can see that acceleration there. Perhaps it'll be a Blue Origin event, straight up, straight down. Great joyride, but not real long-term lasting substance as yet in terms of being anything different or better than what other people are doing. But I got a little bit on sidetracked there. What I was trying to say was the US stock market is showing signs of some price rejection, even in the price action on Friday within New York. And that's kind of flowing through into Asia as well. And I think the rest of the world outside of the US market, which is having this flood of money flowing into it, by the way, capital inflows, investment inflows from the United States have reached 1992 highs. So it's a lot of money coming from the rest of the world into the United States at the moment, pushing those stock prices up, even though the local fund managers are cautious. But the rest of the world is now also part of the reason US stocks are going up is because people are so worried in the rest of the world about Delta surge. So what happens now? I think what happens now is after this initial surge of capital into the US, it will run dry, and then the fund managers in the US will be thinking, these are way too high valuations, we need to offload some of our profits, or some hedge funds might even speculate and go short. I did hear there's still some hedge funds in New York that are heavily heavily long the Australian dollar on a speculative basis, and they still have yet to unwind. So I do see downward pressure on the Australian dollar still. I do see upward pressure on the US dollar still as US corporations repatriate funds and as the rest of the world tries to put money somewhere safe and just believing in this US stock market rally. So the US dollar is going to remain firm. That's going to continue to push the Australian dollar lower. And Australia has serious structural problems that are becoming more and more profound. I think the Australian dollar is still expensive where it is. We're halfway from our 77 to 70 cent forecast. I think it's going to continue to fall to that 70 cent forecast with risk even to 68.50. The stock market in Australia broke the range to the upside but has struggled near the previous high. It's started to fall back into that range. If the market falls back into that range on a closing basis, that previous range, then I think you'd have to call the price action of Friday as a false break to the upside, which will create a lot of downward momentum in the rest of this week. So whilst I got the Australian market wrong on Friday, and I apologise for that, it still doesn't look comfortable, this rally. And I'd still tend to favour managing the downside risks at this point. In terms of currencies, as I said, US dollar strength. I mean, going into the European Open today, I think the euro will again come under pressure, as will sterling. And I think the Australian dollar could be the underperformer of the three. Excuse me, so that sterling Aussie dollar play that we spoke of weeks ago is still working well. I don't see any high sort of price rejection in terms of sterling Aussie going higher. That might be a less volatile, more reliable trade at the moment. Gold is sort of experienced some selling pressure here as the US dollar is strengthening, but I think it will have a story of its own, increasingly a story of its own to move higher. So I still like gold, so obviously I still like Aussie gold. Thank you very much. Clifford Bennett, ACY Securities Chief Economist.